Hello, my name is Brian Overby, and welcome to Options Guy TV. We are taping this episode of Options Guy TV because Monday, February 19th is a holiday. We will air this, but the markets are closed. Right now I'm taping, the markets are open, and we're going to continue our education series. So far, we've done Education Options Trading 101, Options Trading 102, 103, and now we're going to get into 104. On top of that, on other Monday holidays and different holidays within the markets, we've also introduced the Greeks. We've looked at Delta, we've looked at Gamma, Theta, even went as far as talking about Vega. So today we're going to combine this. In Options 103, we talked a little bit about option pricing, and we went through the basics of option pricing. Also, when we talked about Delta, we took pricing to the next level and just talked about the definition of Delta, why we want to know that definition, and how it helps us develop realistic expectations when it comes to pricing an option contract. So today, this is one of the more popular basic webinars that I do from time to time. And it's when and which option to buy. So a lot of people are always drawn to buying call options as their first trade in the options trading market. They find out about option trading. They're like, I would like to leverage my money and I would like to buy a call option on a stock that I wouldn't mind buying. And what call option do I want to buy? Well, one thing about option trading that you have to understand is that there are three different choices when it comes to buying options. Not to mention the fact that there are a plethora of different expirations. But the three choices that I'm talking about is you can buy an in-the-money option, you can buy an at-the-money option, and you can buy an out-of-the-money options. And all three of those choices react differently to a movement in the underlying stock. And that's where Delta comes in. And that's what we're going to try to address today on a very basic scenario. So I'm actually going to use real markets. We're going to go into the TradeHawk software, into the options grid, and we're going to take that data and we're going to look at these three different choices and options. And then we'll also move out to different expirations. And so right now we're showing you the TradeHawk options grid, which is, there's just a lot of different features inside this software, which you can customize to however you might feel more comfortable when it comes to option trading. So let's start with that. Here's the TradeHawk software. Here's the options grid. I'm going to scroll down, or I'm going to scroll up to the very top of the option chains. And you'll see here that we have the calls and we have the puts. We're only going to focus on the call option. So we're only going to be into this side of the options grid. The data that I've chosen to share with you today is we're going to show the delta. We're going to also talk about intrinsic and extrinsic. We'll define those terms. And then obviously we've got the bid and the ask on the option contract. And I just put in the spread leg for when we highlight different option contracts. Okay. So if I scroll down, one of the things that I have done in this version of the option grid is I'm highlighting in the money options, and they are in a lesser gray color, I guess, for lack of a better way of defining that color. And then the out of money option contracts are in the black. So in the shaded area, we're in. On the non-shaded area, we're out. The software also highlights the most at the money option contract. So if you're talking about at the money options, very rarely is the stock exactly at that strike. So to be vague, most of the people, when they say an at the money option contract, they're talking around the stock price. So right now, as I mentioned, we're using live data. We're looking at the SPY, which is the ETF that tracks the S&P 500 index. Very, very liquid, very, very popular trading vessel. And right now that market is at 501.82. So we're highlighting the 502 inside the TradeHawk software, which is the most at the money option. I would call the 501, 503, and the 502 an at the money option contract. That's just, like I said, being vague about it. All right. So the question today is, if you're buying an option contract, is there a golden book of answers as to should I buy an in, at, or out of the money option contract? And to be short with the answer is no. It's really about your approach to the market and what you want to accomplish. So you could say no, you could say it depends. It depends on what you want your option to do for you. But I'm going to tell you why you need to think about it before you enter that first trade or any trade on, it could be your 1,000th trade on option, long call options. And long just means that we're buying it. Once you buy an option contract, you then look in your portfolio and you are considered long that option contract in the portfolio. So once you bought it, you are long that option. All right. So market's jumping around. Now I'm going to highlight delta, and delta means that you're going to have intrinsic, or I'm sorry, this shaded area means that you're going to have intrinsic value. So that means that's real value. That's worth something. You can always get the intrinsic value out of an option contract. If you needed to, you could always exercise your option, buy the stock at the strike, and sell it in the real marketplace at the current going rate. That's how we would determine the intrinsic value. Now, on in the money option contracts, most of the time you have intrinsic value and you have extrinsic value, which is time value. Unless you get really deep into money, you'll see the extrinsic value go down lower and lower and lower, and the intrinsic value get bigger and bigger and bigger. And that happens on deep in the money option contracts. As you go deeper and deeper in the money on your call options, the underlying acts more and more like the stock. You get higher delta, less extrinsic value, and more intrinsic value. And so we got 501 is the most at the money option. As I go down, our intrinsic value is small and it gets large all the way down. Let's say the 490 strike. Very nice round number there. We have $11.49 of real value or intrinsic value, and we have a couple of dollars of extrinsic value. As opposed to going to the at the money option contract, we have a lot more extrinsic value. This is where all the juice lies, that fancy term in option trading. Usually the most active option contract is the at the money. It's also a very explosive option contract in that it moves really quickly. It's very sensitive to stock price movements, and that's usually where all the time premium is at. So you'll notice that if we're looking at the extrinsic value, that's where the bulk of it is. The 501 call, it's 501.40. So let's look at the 502. That's 100% extrinsic value. It's all time value. It's out of the money. And as you know, this is fairly intuitive, as I go further and further out of the money, away from the stock on the call options, I'm going to have less and less extrinsic value. The options are going to get cheaper and cheaper. So look at all the extrinsic value. You have not a lot, you have a lot, and then you go deep into money and you have not a lot. So everything's centered around that at the money options contract. Okay. So if I'm buying options and I really want to use it as a substitute for the stock, as a stock replacement, that means that would imply that I want my option contract to act a lot like the stock. So I'm going to focus right around the 75 delta. Now, if you don't know that definition, you want to go back and watch that video about delta, you can hit pause right here. Go back and watch that video. We might even have the link in the chat box. I'm not 100% sure because we're not doing this live right now. We're taping it. But if that link is in the chat box, you might want to stop and just review what delta is. But delta will tell you how much your option will move for a 1 point movement in the stock. So in this instance, it would be 75 cents, or if you own one contract, it would be $75. That means that if I buy this, let's call it let's call it $10 option, right? Let's round up to a $10 option. And we buy the 495 strike call option here, and I'm going to click on it just to draw your attention. 494. Let's click on that. I'm going to click on the ask, and that's going to put it right here. So we're highlighting the one that we're buying. It's green because we're buying it. We have about a 75-cent delta. That means if this was a $10 option and the stock went up $1, we would expect our option contract to go up about 75 cents, which means that if we bought that option contract, we would make about $75. What I'm focusing on here, though, today is if I buy that option contract, I am buying about $2.74 of extrinsic value, or time value. And that means I don't have a far way to go by that expiration date, and I should focus on that. I'm doing a 14-day option contract. That's the March 1st expiration. All the dates are laid out across here, and you'll see that that box is highlighted, and it shows you this right over here. And if I'm buying that option contract, if you buy deeper in the money options, you pay for them, but the less intrinsic value that you have means the smaller movement to the upside on the calls you need, the less and less, the deeper and deeper you get in the money, the more the option contract costs, but the break-even price becomes lower and lower, the less and less extrinsic or time value that you buy. So in this instance, you're paying real money. If we called it a $10 option contract, you take 10 times 100, that's $1,000 to buy that option contract. So if I do that and I'm buying these options, then I'm spending some real money here to buy one option contract. If I go a little bit more at the money, the option becomes cheaper, but I lose the delta and I increase the extrinsic value or time value, which means it's going to move my break even further away from where the current stock price is at. So in this instance, if we looked at the 501, we'll grab the one that the software is now saying is the most at the money option contract, and I click on that, we'll see the delta right around 54. And I talk about that a lot in the video, that most at the money option contracts are going to have a delta close to 50. We'll just keep that as a fact today. And if you want to get into more detail as to why that is, you'd watch the video on delta. And if I buy this option contract now, instead of paying over here $2.75 worth of extrinsic value or time value, I'm paying $4.80. Almost all of this is extrinsic value. So my break even is going to go up accordingly because I'm paying more for that time value. Now, the delta says that I'm still going to get a lot of movement. If the stock moves 1 on this option contract and it happens instantly, I should make about 54 cents on my option contract, or $54 if I were to buy one option. Okay. Then the last one that we're going to look at is we're going to go about equidistant out of the money. We're looking at about a 75 delta here. So we're going to look at a 25 delta on this instance. This would be like the 509 option contract. And if we buy this one, well, there's one thing that's pretty nice about it is it's cheap, right? It's $1.50. It's the cheapest option contract. It's all extrinsic value because we are definitely out of the money in this scenario. If the underlying stock goes up 1, our expectation would be that this would go up 25 cents, or trading from, let's say, call it 150 for around 175 if we did that. And if that were the case, we would make about $25 if we bought one option contract. But it's cheap. You can buy a lot of them with the same amount of money that you could buy the in-the-money option contract that we first started with when we looked all the way down at the 494 strike. All right, so the question then becomes, why would I want to buy an in-the-money option contract? What's the benefit of buying that contract versus buying the at-the-money or the out-of-the-money? Maybe the out-of-the-money is the best one overall. But the one thing you got to note here is that if you buy that out-of-the-money option contract and the underlying stock actually goes up half the distance right? So we have a 14-day option contract. And, well, let's see if I can do this. Let's pull this off. We have a 14-day option contract. And let's say to you, it's going to be a real quick quiz. We buy the 509 option. We buy this 509 strike call option. It's trading for 150 right now. We have 14 days remaining. Let's say the underlying stock goes about half the distance. So that's 8 points. So it'd be 4. It goes to 505. I think the scenario is going to work out here, as long as the market hangs with me, stays at 501. It goes half the distance and it takes half the time. We go from a 14-day option down to a 7-day option contract. What would the option be trading for? Okay, let's paint this scenario again. We buy the 509 option contract. We have 14 days remaining to expiration. We go half the distance to the strike to 505, and it takes half the time to do it. We will get there. We'll get halfway on the movement of the underlying stock, and it takes half the time. What would your option be trading for? Would you be making money on that trade, or would you be losing money? What's your expectation? And if you can't answer that question with some realistic expectation, then you probably shouldn't be trading options. It's just that simple, right? It's pretty straightforward. And this is actually going to, we're going to get into buying an in the money and an at the money, but this is probably the most important thing to think about. So we can pull this off. We have live markets, and we're in the SPY, and they now have options that expire every day of the week. So let's go to the February 23rd expiration. If the 14th day, 7 days goes away, guess what? It would be acting like the February 23rd expiration. So let's do this. And let's look at the 505 option contract. No idea why it moved this here. And I'm going to move this back here because for some reason we jumped. No big deal. 505. And look at this. Okay. 505. Boom. It's trading almost exactly where the March 1st contract is trading right now. Actually, exactly. That's amazing, because that usually only happens in theoretical. And that's exactly what I was expecting. Okay, so 147, and I'm going to click on this, and I'm just riding with this here. 147, 148. Okay, so why is that scenario? How did I know that this 509 option contract was going to be trading for what the 505 option contract is trading for here? Here's how. Options are based off of probability. And if you buy that out of the money option contract and it doesn't get to your strike within that time frame, you can lose your entire investment, right? So the probabilities didn't change. When we were looking at the March 1st 14-day option at 509 with the stock at 501, we are saying we had 14 days for this to move 8 points. The probability of that underlying moving 8 points was worth $1.49 in 14 days. 7 days go by, probabilities didn't change, right? We went from having 14 days to have the underlying stock move 8 points to get to the strike. Now we have 7 days and we need the stock to still move another 4 points. The probability of that happening stayed the same. And not only did that need to happen, it needed to happen and go beyond that, because we paid $1.50 for it. Our break even is actually going to be $1.50 plus 509 or 510.50, right? That's where the underlying needs to go to even break even on that trade. So if I buy this March 14th expiration, first of all, I need to think it's going to move right away. I do not want to ride that option contract all the way to the expiration. I have to think that within the next 7 days, the stock is going to be close to 509, right? If I don't think it can make that type of move in that time frame, well, then I shouldn't buy this option contract. If I think it's going to make that move, well, maybe I buy the 501. I can't buy as many of them, and that's an issue. So in theory, we should just say we got $1,000, right? This option contract would be $1,000. We can buy 2 of these, and we can buy about 7 of these, right? 7 times 150. I don't have my calculator right off the top of my head. Is going to be close to $1,000. Okay, so you can buy a lot more of them, but if the market doesn't get there, oh well, we lost our entire investment. And now let's go back and think about this. If you're a beginning option trader, and you're first thinking about buying options, out of these 3 option contracts, which one do you think you're drawn to, right? Which one do you think you're drawn to? You're drawn to the least expensive one. Why? Because you can buy a lot of them. You sound great at the cocktail party. Oh, I bought 30 of these 509 call options in the SPY. Yeah, it sounds great, doesn't it? But what are you asking the underlying to do? You're asking the underlying stock to move 8 points in 14 days. The likelihood of it doing that and going beyond that strike so that you can be profitable, if you wait that whole 14 days, is fairly low probability. The low probability is why the price is priced the way that it is. All right. So I'm going to go back to the what if calculator, and I'm just going to highlight this. Now, this is a profit and loss calculator, very handy inside the TradeHawk software. I have all 3 scenarios. Here is the 495 option contract, right? So the market's at 501. If we take the price of the option contract, the cost is $972. We called it $10. We rounded up, but $972 is the cost. You add that to the strike price, you will see that the break even is going to be about 504.73 in this instance, or it would be 72 if to be exact, but right around here. So that's where my break even is. So if I buy this option contract and the market goes up $3, like our scenario that we were talking about, it goes up $4, we're going to be profitable. And the sooner it goes up, the better. If you look at the profit and loss graph, the green line right here, that shows you as of today. So at expiration, you're at break even, but as of today, you're actually making money. So because of that time premium and time premium decays, if I'm buying this in the money option contract and I get that, well, in this instance, 490, 3-point movement, right? Well, 4 points, ideally. I'm going to be profitable on that trade, and I'm going to be profitable fairly quickly on that trade. At that point in time, I would be up, let me see where that line is, $214 on my $1,000 trade, right? On a percentage basis, that's obviously a very, very good trade. Now, I can move this. Let's go in and say we're going to move the expiration date. Let's go out 1 more week, okay? So halfway there, here's our expiration. We're going to go out to the 23rd. You'll see the green line morph into the yellow line, right? Now it's a much closer to where it would be at that break-even price. So bottom line is I can buy this option contract. It can move a couple of points, and I can be profitable. That other option contract, the out-of-the-money option contract, which is the 510, I'm going to click on that, switch this graph. My break-even is 511.45. 511.45. I need this thing to move right away. If it gets there right away, I'm more profitable. But if it doesn't, I can lose my entire investment. Look at that 0 line. And let's see what happens when we move this line now and we go out 1 week. All right. We go from this date, the 16th, to the 23rd. Now I really am in danger, right? It's a lot scarier because I've just lost a lot of loft in my rise over my run on this trade. And so then where's the happy medium? Well, you buy the at the money one, right? Now the at the money one still has a rough break even in that I needed to get to 506. So our 4-point move in that time frame would maybe get us a little bit of profitability, but it's still not to our break-even point, right? It's still not there. So if we don't close out at that second and we ride it all the way to expiration on a 4-point move, we still don't make our money on our at-the-money option contract. So if I take this and I move it, let's go to day 23 again. Watch the green line down here. Watch how much it morphs towards the expiration graph. And yeah, that one that held up a little better than the out of the money option contract, right? It didn't lose its time value as quickly as the at the money did, but it still hurt. So, moral to my story is you have a forecast. You're buying an option contract. We're only looking at a 14-day option, where that's all that we've looked at here. And I'm kind of running out of time. I might have to do a stage 2 and talk about how the expiration affects it. But if I'm just looking at that 14-day option contract, if I think it's only going to move a couple of points to the upside, I need to buy less options, buy maybe just one, but I need to buy an in-the-money option contract to get rewarded for that. If I buy the at-the-money one, well, I don't mind that as much, but then I got to be really cognizant that because I'm paying a lot of time value, and every day that goes away, it's going to hurt. So I need it to move quicker. And if I'm buying an out of the money option contract, I need it to move big and I need it to move fast. And if that's not your forecast, then that's not the option contract that you should be buying. My name is Brian Overby. I am known as the Options Guy, the author of the Options Playbook. If you'd like to learn more about these concepts, please go to optionsplaybook.com. That's the companion website to my book. And we'll see you here on Options Guy TV. We post it live using live markets, if the markets are open, every Monday, Wednesday, and Friday at 11 a.m. Eastern Time. Thanks for coming, everyone, and hopefully we'll see you soon on Options Guy TV.